Good morning, everybody. Welcome to the Flow Show. I was nearly late there. I was rushing at the last minute. We were having a laugh in the chat room about Elon Musk's 2.4 miles of tunnel. Anyway, morning, Kay. How you doing, mate?
Morning, Ryan. I thought you may not look at the clock straight away, and I was seeing the time ticking by, and I was telling myself he must have a chuckle about what we were laughing about in the chat room.
Yes, nearly slipped up. I thought I had a couple more minutes, and I did, but anyway, got them in the end. Made kick off. That's the main thing. So yeah, good morning to everybody. Hope you're doing well. It's Fed Day, and yeah, probably going to have a lot of sitting around, I think, until we get to the Fed later. But that time we can use to get planning for any possible trades. Right, let's get through some of the news. China is going to continue its support for the property market. According to state TV, they're going to, or they vowed to prevent builders' debts from defaulting. Obviously, if that happens, then a lot of people who bought properties are at risk of losing those, so they're going to continue to keep those propped up. Over in Japan, we've had a bit of data out, and potentially quite important data, because this data was mentioned in all the prior Bank of Japan stories and conversations and sources and whatnot, being particularly important. That was the Tankan survey. So this is the quarterly survey for Q4. So it's more like a bit of an expectation survey than anything. And some pretty positive numbers there. Large manufacturing index going up to 12, beating expectations, the highest for quite some time, apparently. The rest of the numbers looking fairly positive. Some misses of expectations, but largely they're all looking pretty good. Non-manufacturers as well looking positive. That's some of the other outside of manufacturing and smaller manufacturing numbers as well, also positive. So on the whole, if they're looking at this one as a reason to suggest that the economy is doing fairly well, then these are the numbers that back that up. However, it needs to translate into the hard data, which in the manufacturing sector has not been overly great of late. So anyway, decent numbers from Japan there. Kay's is the Tankan's always a report to look at, but it's been given a bit of importance now with all that chatter, hasn't it?
It's the issue is, Ryan, that everybody's waiting for all those central banks. Everybody's waiting for the Bank of Japan. Everybody got their moment of glory in a way. But then, if you look at how the data have impacted the yen of late, it seems like a long spun out project or something to look at, but over the long term. Yeah, I found that report pretty cool as well. But then looking at how the market reacted to it, it really went before the report came out. The dollar yen went a bit lower, but then straight after the report came out, it recovered. So it's always been a difficult one to understand and to trade yen on the back of Japanese data, right? I've been market making yen for 18, 19 years or so. And it's always been, I really had to ask Japanese people, do we trade these data or not? Or do we see flows on the back of it or not? And even their response was not always obvious. So yeah, I find that report pretty okay. The problem is, against that, we still have those real wages and things that are negative, and the market is really, if you purely trade yen, not the rest around it. Like for instance, if you trade dollar yen, the dollar is going to impact. But if you purely trade the yen, I guess the people are just waiting for what the Bank of Japan and the speed of the Bank of Japan now, and those economic reports can come into play really if the Bank of Japan starts to move and the economic reports remain good. Then you are going to be able to trade those. But now it's really difficult to trade on the back of Japanese economic reports. Really difficult.
Yeah, I'm just wondering if they're doing a bit similar to what Powell did earlier this year. Do you remember? It seemed every FOMC meeting they were looking at. He would highlight another different piece of data they were looking at each
Yeah,
time.
well,
Everyone started looking at that one. I know they don't play those sort of games, but
yeah.
it feels that way. You know, they've mentioned consumption. You know, those ones who railed against Ueda's comments. They said, "Oh, you know, consumption needs to improve," and then we're looking at the tank, and it feels like they're just finding excuses now for
That-
why they shouldn't tighten more than why they should.
Yeah.
But,
One last word I would have about this tank, and if I may, is that we already know that the big exporters have record years of profits, right?
Yeah.
The car makers, the big machinery makers. So the old big industry raising is kind of normal. But then you have a pretty decent number in there, which is the capex, and that remains, the big industry capex remains relatively elevated, which is pretty cool as well. I'm just running through these. Also, the small businesses, right? That remains on a low level. Okay.
Yeah.
And that perhaps is something that we could say, like, okay, perhaps that's not yet your bright spot, but because there's a lot of small businesses locally, and the big manufacturing and the big exporters, they are much more looking outwards than those smaller companies, right? So
Yeah.
perhaps that is causing a little bit of a balance between good and less ecstatic. But yeah, all in all, it's not a bad report. Get such a report in one of the other economies, like I don't know, Euroland or the US, people would say like, this is good.
Yeah. And maybe you know, because we're in such a bit of a Fed orbit at the moment, maybe this is something to look at for Q1, something like that,
Yeah,
when we don't have all these
yeah,
outsized forces at play this time of year.
yeah.
But yeah. Right. Well, Japanese regional banks are still chomping at the bit for the BOJ to normalise. The association chairman of those regional banks says the chance has come for the BOJ to normalise. He says it doesn't expect much burden on borrowers if the BOJ raises rates. So everyone's gearing up, getting ready for what's to come potentially next year. Over at the RBNZ, they've had the government report or its monetary policy remit amended by the government. They're keeping the 1 to 3% inflation target with focus on 2% midpoint. However, they've removed the objective to support maximum sustainable employment. So they've moved the goalposts a bit on that, made it more about inflation than the rest of the economy or employment in particular. So it gives a little bit of leeway now for the RBNZ. Over in the UK today, the world is falling apart. Last month, when we got GDP data, everything was rosy, jelly and ice cream. Today, the world is falling apart. The UK is falling to pieces, people. We've seen a negative GDP number, down 0.3% versus 0.2% in the prior month for September. So hell has broken loose. Oh, it's Brexit's fault. It's everybody's fault today. Such is the nature of the UK press. Let's be honest, the data isn't great today. Industrial production, manufacturing production, all looking pretty bad. That manufacturing particularly down 1.1%. Industrial production, as I said there, not looking good at all. So a Dow review of the economy from these numbers. The light switch has flicked, and as it can do now and again. And as I say, everyone's looking more bearish now today. Obviously, traders have ramped up bets on rate cuts for the UK, blaming the poor data. It's amazing how they ramp up rate cuts on a negative number, but didn't ramp up hikes on the positive number last month. taking it all together, okay, particularly growth, it's the 3 month change. It's all like a running quarterly number that you need to pay more attention to. And for me, that hasn't done anything. All it's done is shown that we have got flat growth. There we go, 22, 23, nothing, just bumping around that line. So it doesn't really matter whether it's plus 3% or plus 0.3%, minus 0.3%, 1 month to another. It all still circling around the flat line. So that's the trend that we need to watch. And it's not collapsing and it's not doing anything spectacular. So let the market panic about these month-to-month numbers and get yourself in a flat. Look at the wider trend, and the wider trend, like a lot of countries, particularly in Europe, we're flatlining like everyone else. So that's what the Bank of England will take into consideration. It will not be changing its policy for Thursday or its decisions for Thursday based on the month-to-month numbers. We start seeing a bit of a dropping trend. We start seeing growth minus 1%, 2%. Then the Bank of England will sit up and take notice. We know Bailey is very pessimistic on the economy, sees the worst outlook he's ever seen, according to his prior comments. So these numbers just keep him in that tone. But I still expect the Bank of England to be concentrating more on those inflation and wage pressures than GDP numbers. But we shall see what those clowns want to do at the meeting on Thursday.
Do we have a press conference after the meeting tomorrow?
I don't think so. I don't think
we've
got an NPR. We had it.
I haven't seen one.
Might be. Let me think. That's quarterly, isn't it? So it's February, May. I'll have to check it. I don't think so.
I haven't seen one, so I don't know.
No. I'll double check it. We've got a couple of days anyway. I don't think so, but I could be wrong. But anyway, all that hasn't stopped.
Thanks, Mark.
Apparently, sorry?
I said thanks, Mark. Mark Harvey says no press tomorrow. Okay.
Thanks, Mark. Asset managers don't care about that sort of data. Apparently, they are snapping up the pound purely on the inflation concerns. The City did a little bit of a report using their seaweed and tea leaves. They say that overseas investors have purchased a quid at the fastest rate since the summer, and a lot of that has come since November. So that's why the pound was supported, as we saw last month. Not that it's remained overly supportive, or that some of that buying seems to have washed out now, but asset managers are the ones who like the quid at the moment on inflation concerns. So we'll see if that lasts over the Bank of England tomorrow. Right. Some funny lines out of Germany this morning. The IW Economic Institute came out with its forecast for 2024, said the German economy will fall 0.5% due to the budget crisis. 22 minutes later, the German coalition agreed the 2024 budget crisis averted. So that's probably got to be the fastest prediction to be blown out the water I think I've ever seen. So, yeah, the budget stuff appears to be sorted. Obviously, K-Man's going to go through the details of that and let us know whether it's a good or bad budget. But anyway, and the headline just popping up now saying the German coalition won't suspend the debt limit again next year. So we'll get to see whether it's good or bad. But that crisis seems to be passing for now. Back to the data, yesterday's CPI data. In the end, it came out bang on the money. CPI 3.1% as expected. The core 4% as expected. So right on the numbers. And what did we get? We got a bit of a washing machine move. Firstly, dollar yen popped very quickly to 145.50s. Then it dropped all the way back to 144.70s. Then it ran all the way up to session highs and higher, all the way up through 145, 143, 570s, 80s. So it was a bit of a strange move because I was sitting there. I I took a little punch short before the number because I thought the numbers might be a bit softer than expected. Managed to take a few pips out of that on the short. But it was a very strange reaction. Immediately futures trades in swaps and FFR markets started to price a March 2024 cut, and that got quickly reversed as everyone came around to the thinking that despite inflation coming back down in the headline, it's still sticky. As I pointed out, yeah.
Yeah, I had a bit of a thought on that move that we saw immediately after the numbers, and I think that is really a warm welcome to all the electronic business land. I guess some people had taken positions and then immediately got stopped out, and then the market goes the other way around. It's one of those moves, where you go like, right. Let's say, for instance, you want to you buy dollar yen at 145 and a quarter, and you put a stop at 144.90, and you're done in the next 30 seconds, and then the other move starts. I really think it's kind of those moves that we saw right on the release of the numbers.
Yeah, but it was funny because exactly as you said, the market was itching to sell dollars, and it tried selling dollars, and then all the propeller heads got stuck into the numbers. The super core that some people look at was up from 0.22% to 0.44%, but none of the numbers screamed sell the dollar, which is why I got out some of my short as quick as I could. But I didn't go the other way. I don't know why I didn't go the other way, but. Yeah, it's sticky. These numbers are still sticky, and that's going to be the basis of the Fed's talk today. If we'd have seen much softer numbers, maybe they would have a change, not come across as hawkish, perhaps, but they're going to say the job's not done yet based on these numbers. As I compared with the ECB or the Eurozone yesterday, that's not sticky inflation. This is still sticky inflation. So this is going to give the Fed tonight the ammunition or power, the ammunition to say job's not done, higher for longer, rate hikes are still possible, and we're going to keep going until we get inflation back to target. So I'm still expecting them to be on the more hawkish side than perhaps a lot of the markets are expecting. Whether now we see a reaction to the upside because the market, as said, seems to have already made that move. It's got a little bit more bullish. Even when you look at yields, we're still hovering, but we're not going down anymore. So probably if they are, we're probably going to see a rally in yields, a rally in the dollar. I don't know how far, how much, before everyone comes back in and starts getting on the cut trade again, because they're not going to let that bone go. But that's what I'm looking for anyway. Later on for the FOMC, a bit of hawkishness, a bit of a rally, and then see what we do from there. The 30-year bond sale, seemed to go by pretty okay.
Yeah.
Decent take up. No real tail.
No. It was very okay, and I think the market was a little bit how shall I say, reluctant going into it because the past couple were like a bit miserable, but this one went okay. So we had a bit of a worse 3 years. We had an average 10-year, and then we had a pretty good 30-year. So make your choice, really. It's let's say it went okay. That thing. That's really all.
Yeah, it wasn't a problem. Moving on.
Yeah, exactly. I mean, the thing is, but while we're on it, Yellen came out with some comments last night as well. I don't know if you were going to cover them.
I was just going to mention them briefly.
Sure,
yeah, go on. You can give your interpretation if you like.
Oh, no. Actually, she came out with some I won't call it dovish comments, but she said like, we're in a soft landing scenario, confirming what everybody else already knows. And then she said she was pretty confident that inflation would come back to target as well. It did have the A little bit of impact perhaps, but it was really not a lot. 10, 20 points, perhaps, because the euro dollar was trading around the lows when she came out with those comments, and just put it back up to 90 from 70s. But yeah, that was a comment. I didn't know whether you were going to cover it, so just
Yeah,
so.
the thing, the comment that you're right, mate. The comment I picked up from her was that she didn't think the last mile of getting inflation down was going to be difficult, which is not what Powell has been suggesting, or some of the Fed heads. They think that this last stretch is going to be the more difficult part. So it went against what the Fed are saying in part, but we've got to remember Yellen isn't at the Fed anymore. She's in government.
Exactly.
So you've got to understand that's her perspective now.
Yeah. She wants to borrow cheaply.
Yeah, I bet she wouldn't have said that if she was sitting in the Fed chair. She'd be saying, "Oh, inflation's sticky and the last mile is going to be difficult."
Yeah,
so,
absolutely. Absolutely.
So, yeah.
She's talking for her shop.
Yeah, got to know what seat she's sitting in. One other piece of news from the US, it's probably nothing we have to worry about in terms of content, but more about its rhetoric. That was a New York Times reporting on a 53-page report, which included nearly 150 recommendations from a bipartisan group of US politicians talking about raising tariffs and severing economic ties with China. Okay, politicians have issued a report, all these recommendations. Getting them through is another matter. I think of more importance is that this report has been issued and it's quite scathing. How's that going to play on ties with China, which had been looking like they might be improving? Various meetings between officials recently, seemingly like they want to sort stuff out, and then they go and issue this report, which won't go down well in China. So all part of the ping pong politics, good cop, bad cop routine that we keep seeing. But I haven't seen anything from China in relation to that yet, but we shall see. Sorry, mate.
And elections next year. Perhaps it's already start of the games.
Yeah, exactly. So that could be part of it. But this is a cross-party report. So don't know what that means. Anyway, enough of that. That's all I've got on the headline front. Kay, any gems dropped into your lap?
Yeah, two things. I know you mentioned the RBNZ, but there's a couple of things to mention there in regards to the Kiwi and the Aussie. So we saw the Kiwi current account come in like really, really bad, and Kiwi started to sell off once that came out. I don't know about the timing, but and it's not on the calendar, but the CBA consumer report came out as well, and that showed a better picture, actually, much better picture than last time around. And that, I think, is also partially responsible for the weakness of the Kiwi, maybe accentuated by people wanting to get long again in the Aussie Kiwi. So that seems to have had a pretty decent impact. I don't know exactly what the change of mandates at the RBNZ are worth, but we knew that they were coming. The new government had already hinted that. So I'm going to bet more on the fact that we have this discrepancy between the data in New Zealand and Australia, which really have pushed the Aussie Kiwi up overnight.
Yeah, thanks, mate. Right, so over to the Fed. Don't need to say much more. I've given my thoughts. I expect them to be to stay hawkish. I expect a bit of a stronger pushback on that sticky inflation than Powell gave a week or so ago at that college where he was speaking, where he rattled off the same old message and the market pretty much ignored it and carried on pricing cuts right after. So I'm expecting a stronger pushback from Powell on that. Obviously, we have the QT conversation to come up. Are they going to slow it? That might be a conversation as well, or question that's been asked. Again, I don't think they're likely to give much on that. They want to get the balance sheet down, whether they're cutting rates or not. And again, you have to understand why they're cutting rates. It's not an easing cycle to avert economic weakness. It's just getting rates down from a high level. So yeah, I'm expecting Powell to come out a bit stronger than he did the other week, and keep that message in play. Kay, what are you thinking for the FOMC tonight?
No, I've already said it in the chat room. To me, it's stay the course, and perhaps that kicker, because the RRP reserves are coming down pretty rapidly. So perhaps one of those target journalists, is going to ask him the question about what he reckons to do on the QT. We're still about, I'd say, 250, 300 billion above levels where it could get a little bit hot, but or perhaps even 400. It's been coming off relatively rapidly, but it was also expected, right? Because those people are putting that stuff in there for a reason, because they get free cash. And if you imagine that you're better in bonds, you are also going to make that cash work in a different way, like the money market funds and stuff. So everything is still very normal. So my base case is just a stay the course. In theory, it should actually be a very boring meeting compared to what we may have tomorrow from some other central banks. That is somewhere my theory.
Yeah, no, that's completely possible as well. I think it depends. I mean, I didn't think we'd get such a strong reaction on the CPI yesterday, and we did. So who knows? We know the market is leaning dovish. So it's just a question, if Powell is hawkish, how much does the market believe him again? If it believes him a bit more, we get a big move. If it doesn't, we get a little move.
Yeah, sorry. We also have to make a distinction between the markets. There's been a lot going on in the bonds. There's been a lot going on in equity markets. And then on Friday, we have like apparently a monster triple or quadruple witching coming up as well. But if you look at FX has been pretty stable in a way, more of a spectator to other markets than for instance, equity and bond markets may have been. And as you just mentioned as well, the reaction over the CPI wasn't really. We have seen CPIs move stuff 100 or 200 points, right? And here we had like 50 points in the euro dollar. We had 50, 60, 70 points, let's call it, in the dollar yen. So that's not really big moves. So there's two possibilities for me. Either the FX flows or real money flows are waiting to have the whole central bank package, and then they will do their big end of year stuff, or those real money flows have already done what they have to do, and now we really are only trading short-term stuff and react to what those central banks will be doing, and perhaps we should not expect too much in effect. So there's this. I'm a little bit in between two seats. Let's put it that way. Between what to expect or not, because I'm really, in theory, for me, the Fed should be pretty straightforward. So I don't know what to expect on FX. I really have in mind that tomorrow may be a bigger mover, because the other side of the pairs,
Yeah, no, it's quite possible. So I think what you've got to do today, for all the talk, all the analysis, whether it's us or anyone else you listen to, is get into your charts, pick your assets, pick your important assets. The 10-year yield is always an important asset to watch over things like this. Learn what your levels are. We're pretty much in the middle of this range between 336s and 408, 409s. So, if you can't break any of these sides, then you know how the market's going to react. If we get a hawkish meeting, we get up here in yields, the dollar's going to react. As soon as it runs into trouble, that's when you know that move is potentially coming to an end. So if you feel that the Fed is dovish or is going to turn dovish and cuts are going to come, then this rally in the dollar on the back of yields is going to potentially give you an opportunity. So you line these up with what's happening in other pairs like dollar yen. You know, I'm still waiting for a decent rally in this one. I still want to get into shorts. I might just have to jump in at some point, willy nilly. But you know, maybe a move up to 147 would tie in with yields around going up to that 420s level, 430s level. And if you bump your head there and dollar yen's bumping its head at 147, then at least it gives you an idea of where your risk lies. If you can't get through there, you want to try a short, fine. 20 pips, 30 pips through there, you're wrong. No big risk you need to put on it. Same on the downside. I'm probably going to be looking at this 145 zone again. It's obviously been cracked a couple of times. So down there, back towards that fib, is the sort of stretch point I'll be looking at for anything dovish, and it's the know that that's the way the market is leaning already. So it's probably going to be easier to see it sell off, the dollar sell off, than it is to see it rally because of the way the market is leaning, sentiment is leaning. So yeah, just do your analysis, pick your levels, whatever pair you're trading, Aussie dollar, if you're trading dollar pairs, Aussie dollar, CAD, Loonie, Euro, cable, whatever you want to trade, get in, pick your levels, know where you want to, where your risk, where you want to assign risk. You know, cable 124.50 could be a consideration. We are holding this 125, but we're 16 pips away. That's going to count for nothing if we're 16 pips away into the Fed. But 124.50 may do something. Back up towards 127s, 126 may do something. So do your analysis, find your levels where you would prefer to trade if they were touched and if they hold up, and that's where you put a trade from rather than trading in the middle. Kay, what are you looking at? Any particular pairs for tonight or assets tonight?
Well, as I said, as I already said, I think it should be pretty straightforward. Let me just kill my squawk just a sec. Luke is talking. All right. The pairs. Do you want me to take it or should
yeah, you can if you want. Yeah.
Yeah. Okay. I'm just going to show a couple of things, but it's going to be relatively fast because, again, I think we will. I'm not saying it will. Everybody will. Not everybody, but the accounts will need to manage their books regardless what the Fed says. Okay. There's always going to be moves, and even if it should be a boring movement. Should be a boring meeting. It really we are going to see moves now. It all depends whether those moves are big or not. And Ryan already showing those US 10s. We are on a bit of support there as well. Not too far from where we are here, anywhere between 410 and 415. It was your prior low as well. So if there would be anything really dovish, which I don't expect at all right now, it's really a 5% chance, not more. Then the dollar will of course come under pressure. But I just want to get back to one here, and that is the gilt yields, the 10-year gilt yields in the UK. And we've had this move in sympathy with all the other yields as well, but we are coming into an interesting zone here. We've seen quite a bit of traffic on the way up as well in the UK yields, and now with this combination of what we saw yesterday on those probably a little bit on those numbers yesterday, and then but especially today on this week report. Yields are getting a bit slapped in the UK, but we are on a relatively interesting zone here. I was saying in the room 383 to 391. We are inside. Okay, I should stretch it down to perhaps 375, but we're coming into an interesting zone, and also we have the Bank of England tomorrow. So this is a little preparation on what can happen on the Bank of England tomorrow when we. And if we are in this zone. So watch this carefully, because if it starts to continue to break down, it should weigh on the sterling in some shape or form. Okay, so this is a pretty important zone we are entering right now on those gilt yields, in my opinion. What I'm looking at, well, I'm going to look at, so first of all, because we will have the SMB before our next flow show. So this is on my radar, between the FOMC and the Swiss National Bank tomorrow morning. This is firmly on my radar, the dollar Swiss. Still, I've already said magic level 88, 15, 20, 25. That's where it needs to break. So if we get a bit of a hawkish report on the Fed, it may not reach there again, but we will see. If in turn, if we get a bit of a more dovish report for once of the S&P, then I think though that it's possible that we are going to at least revisit and perhaps start to break. If any hawkish stay the course from Jordan, despite the strength of the Swiss franc, despite them being firmly in their target zone on the CPI, despite the economic forecasts weakening a little bit as well. If he stays the course, then it's probably something that I'm going to give up for the next 3 months again and not even look at the Swiss anymore. I'm just a tad in this already, and see if we can finally start to make a move up. But goes back below 87, I'm going to get out of it. Hopefully, stays alive until the S&P tomorrow, and then we can start to look at the top side perhaps. So the other one we have to look at the cable, right? I'm in agreement with Ryan. Bank of England should not change anything. There is this possibility that the vote changes a bit more into neutral, more into neutral territory, or more people voting for keeping the rate unchanged, which may be perceived as a little bit more dovish. So this is going to be the first area I'm watching here. That is around 124.85, 95. And then, yeah, there's the 124.5 as well, where we had bottoms before. But then I think the danger zone perhaps for the cable is going to be anywhere between 124 and 124.25. That's going to be the danger zone. If you start to get to go back up, then your 125.95, 126.15 is going to be the one, and then we're talking again about levels closer to 127. But in looking at how the economic data came out, this one could be one of the more vulnerable in the combination between FOMC and Bank of England. If Bank of England goes a little bit more dovish, and as Ryan already said, Bailey, although these last three interventions, I would say, or last three times he really commented, sterling rather rose than came down. But it's again another danger day for the cable tomorrow, I would say. Euro is all about what's going to happen, and this hasn't changed. What's going to happen? Yesterday rallied very close to it, 108.30, sorry, and 107.35 again. Give and take the algo pips. This is really your range to watch, and I would suspect that before the ECB, if I'm correct in with my assumption that the Fed could be something of a nothing burger, that we are still in this range. I don't expect this to break up with my expectations for the Fed. But tomorrow over the ECB, we will see what they will be talking about. The data have been deteriorating. CPI has been accelerating to the downside. I would suspect that this is another pair that could retest the low end of that zone. And if that would break, then we talk about 106s again, yeah, 106.60s, and which has been traditionally an area where the market has shown up with interest. So yeah, those are the two boundaries that I'm watching now. That to the short side. Still don't like the euro very much. But above 108.30 and hold, I'll be out of there. I'm got a pretty okay average right now, because I sold it yesterday after the CPI around here, around 108.16, and already managed a little bit. So pretty cool right now. And those are the main pairs. The dollar yen, I'm still is still one, and I know that we could be looking at selling rallies here. Up in those 146.5 towards the 147s. But I really don't know. I mean, and if I don't know, I prefer not to have anything. Perhaps the occasional little scalp here and there when it's obvious. I'm still not completely won for the side of being long yen, but so I'd rather buy a dip and then come back to somewhere in the middle point. But I'm not like looking at these to go back up to above 150 or so. Let's put it that way. I'm more like in a range feeling right now. Just one last little bit here. We have to look at the metals because they have been, especially gold and silver as well, but they have been reacting very fiercely, very impulsively over the past sessions. We are gradually coming into support. I think this first, to start with 1970, 70, 78 on gold is one. And then if we would get lower, I've got a trend line coming in and I've got those prior lows around 1930, 1940. That is going to be a major support zone if ever the Fed is hawkish and gold decides to go for this lower level. It might just be enough there. I'm going to really keep a very close eye on the what gold is doing if ever we get into this zone, because I may just get my butcher's glove out of the drawer and start to catch that knife here. Silver a bit similar. The levels are a bit closer in the low 22s. Perhaps start to have a look at looking if I need to add or want to add again to my a very long-term position, which has now a lot of room to add, but still, we'll be patient. We'll be looking at what the Fed is saying first, and then see the reaction on the rates market. Okay, before making a decision here. And really, Ryan, that is about what I'll be looking at today. We'll be looking, of course, at other stuff, but yeah, perhaps you can look at your Aussie because that's not too far away from the 65.25 again, right?
Yeah.
Yeah. I'll pass it back over to you for that.
Yeah, thanks, mate. I'll take it very quickly before we finish up. Just make sure, can you see that okay?
Yeah, we can see it. And I just, while you're looking at, oh, that's Euro sterling. I thought you were looking at the Aussie. While you're looking at the Aussie, yesterday I said that Kiwi was a currency on my radar to actually trade a weak dollar for a breakout topside, but that's completely off my radar right now. Just wanted to mention.
Yeah, thanks, mate. Yeah, so there's the Aussie dollar. Again, we've got a decent level down here. We're a bit close though, 50s, down to 25, 30s this zone. So it is a bit close. But, if there's no big moves and we have a test there and hold it, it's going to show up as another strong support point. And then maybe we get another rally up towards the 66. So, yeah, and then 66.20s looks to be the number up top as well. So again, decent range to play in. It's going to have to be something really strong either side from the FOMC to probably break these ranges. So even if it is something that's hawkish and we break it, watch how it reacts. If you quickly get above that zone again after the initial reaction, it's likely to come in play again, and then you can potentially form a trade. And while I was looking at Euro sterling quickly, mate.
Yeah, will you buy it straight away on 5.25 or wait for it to go below and then buy it on a break back above?
Yeah, because we're so close to it, 25 pips away, that's nothing on this. So yeah, I think you have to wait for if it's a hawkish reaction, dollar getting bought, you have to probably think maybe a break, and then maybe look at something like the big figure 65 as somewhere to maybe try catching that knife, or as you say, if it's a quick spike and it gets back above and then you start, you know, bouncing around in here, that'll suggest, you know, that's the time to buy it. So yeah, wouldn't go with initial reaction, not 25 pips away on the announcement. No.
Yeah, because buying it straight away puts you at risk, right? And that's perhaps not the ideal situation here.
Yeah, you always want confirmation. You know, if we were trading, you know, towards 66, then I might buy a reaction down to there, because that's a 70 pip move, you know, 80 pip move. You know, judging what the headlines are, if it's, you know, a little bit hawkish, nothing major, nothing game changing, then you'd expect the price to run into trouble there. So that's what will give me my conviction to try a quick spike trade. But when you're 25 pips away, no, let the price do its thing, give it 20 minutes, the presser, whatever, see what the dollar wants to do thereafter, and then make your decision on that one. And if we finish the day and POW back above the level, then you know it's going to be support again thereafter. So even if you don't grab the first trade, you might better grab the secondary reaction, because you've always got to wait for that press conference second wind. But yeah, Euro Sterling, I'm actually looking at this one for a potential short, just a BOE trade, because I think they're going to be a bit more hawkish. And I'm still long, but I'll do a separate trade short, and maybe a hawkish Fed will help get better levels in this one, because we know cable moves more than the euro dollar when the dollar's moving. So if it's a hawkish number and we're seeing dollar strength, cable will probably drop more than the euro will. So that will mean Euro Sterling might push up a bit higher. It's not guaranteed, but you know, that's the way, as I say, cable tends to work versus the euro dollar when you're talking about the dollar side. So if I do see a decent rally in this, I might just nibble into some small shorts to run into the BOE tomorrow. But anyway, that's for tomorrow or later tonight. Enough of the talk. Watch out for the PPI data from the US as well today. May not have too big an impact unless, again, there's a real big variation in it, but it's still a little risk ahead of the Fed tonight. Woof, that's that. Have a great day, everybody. Trade safe tonight over the Fed. If in doubt, stay out and pick it up after the dust has settled. Thank you, as always, Kay, for all your wonderful stuff. Well, we will all see you in the chat room, obviously. Thank you, and we'll see you tomorrow, guys and girls.
Thanks, guys.